It has been taught that one of the most secure investments in your portfolio is real estate, because having investment properties can provide a stream of passive income for years to come. However, depending on how you're structured your investment properties, you may not be maximizing your investments. Hi, I am Jackie Yip, Certified Financial Planner at Ocean 6 Wealth Advisory. In this video, I will share the 3 things you must do if you want to maximize your returns for your investment properties as a business owner. Building a portfolio of investment properties is something most successful business owners I work with have dreamt about. Especially in this hot housing market, it seems like you just cannot go wrong. It is no secret that a lot of people have found so much success with their investment properties. But have you ever wondered if you are set up to maximize all the benefits of it? In the first meeting of our blueprint process, we do a deep dive into your debt situation, and we get a glimpse of how you've structured your properties. This is usually because most people still have a mortgage with their properties. When I see a client with an investment property that has a traditional mortgage, I know immediately their setup is inefficient. The first thing you want to remember about investment properties is that it is all about the cap rate. The quick version of a cap rate is the annual rental income divided by the market value of the property. Notice how I said market value of the property, not the purchase price. This is key because you want to know whether or not you are properly compensated for your dollars today. In 2021, I have noticed that there has been a slow decline in the downtown Vancouver cap rates. What was once 3 to 4% has now fell to rates closer to 2%. One of the biggest driving forces is the prices of properties are going up, but the rental rates stay flat or a slower increase. As an example, a property that is worth about $700,000 in downtown Vancouver is now renting out only $1,200 per month after expenses, which makes it at 2% of the property value. That is not a very good return when other parts of BC and other parts of our country can yield closer to 5 to 6% cap rate instead. The second thing you must do is convert your traditional mortgage into home equity lines of credits. Traditional mortgage is when you pay both principal and interest payments each month, whereas a line of credit allows you to only pay the interest. Every time I mention this, most people look at me with a puzzled face because they have always been taught to pay down their debts faster and apply all of their savings to paying down the mortgage. So the reason why you want to pay interest only instead of the principal is because of income taxes. As a business owner, our income is probably going up every year. And when we are paying down the principal of our investment properties, we are lowering our interest expenses too. The way I see it is that you are forced to pay down the principal with a mortgage, but the principal amount is actually a taxable income on your end. It is income you've earned and paid taxes for, but you don't get to enjoy. The money is trapped in your property until you sell it. So if you have a line of credit and pay interest only, you can redirect the principal amount towards your principal home mortgage first, because that's not a tax deductible and you are slowly paying down your own property with a rental income instead. If you don't have a principal mortgage, then consider investing the difference instead. From my perspective, you should always pay down your investment property's debt last, since you can enjoy the tax deductions first. Lastly, if you're a business owner and you've been purchasing the properties in your personal name instead of your holding corporation, then you are purchasing a far lesser value home because you've been paying too much income taxes. Think about it. If you need to take out $200,000 for a down payment and you are buying this property in your personal name, then you must pay income taxes of about $133,000 first. Whereas if you're purchasing the property inside your holding company, then you would have $333,000 to invest with and buy another property or a bigger property. Taxes can be a silent killer that is dramatically lowering your investable capital. And once you pay your taxes, it is not possible to get that back from CRA. By purchasing the property inside your holding company, you have more capital to invest with, and when you sell it, you will also create CDA credits, and now you can take out tax-free income from your holding corporation. I won't get into details of CDA credits, but I invite you to check out our other videos where we do a deeper discussion about that. So that's it. If you want to maximize your investment properties, you want to be rational with the cap rate of the property. Don't forget to restructure your debts so that you're winning and not the banks with lines of credits instead of traditional mortgages. And finally, pay attention to taxes. If you're not purchasing the property inside your holding corporation, you are investing with less than what you can be and giving away a massive tax benefit with CDA credits inside your holding company. If you're a business owner and wants to discuss how to maximize your returns of your investment properties, don't hesitate. Book a call now and I would love to help.